All right, let's talk about a sector that can be a real minefield for investors: health insurance. It is absolutely full of confusing terms, slick marketing. So, how do you even begin to tell the difference between a solid company and one that's just smoke and mirrors? Well, in this explainer, we're going to give you the tools to do exactly that. Let's jump right in. This is really the big question, isn't it? For customers and for us as investors. Are we looking at a genuine safety net that's designed to protect people when they're most vulnerable? Or is it a tangled web of confusing clauses and flashy add-ons designed to do one thing: maximize profit? Figuring out the difference between the two, that's the key to spotting the strong, sustainable companies in this industry. So, here's how we're going to break it all down. First, we'll look at the products themselves, the gimmicks and the good stuff. Then we'll dive into the numbers that really matter. After that, we'll touch on customer rights. And finally, we'll pull it all together into a simple framework to help guide your investment decisions. First up, the bells and whistles. Insurance companies just love to offer these little add-ons to their basic policies. Now, some of them are genuinely useful, while others, well, not so much. Let's learn how to spot the difference. Okay, let's start with a feature called consumables cover. You know all those little things on a hospital bill that add up surprisingly fast? We're talking gloves, masks, syringes, administrative fees. These can easily make up 2 to 10% of the final bill. Now, some insurers will offer to cover these costs for a little extra premium. So what's the verdict? This is definitely not a gimmick. It's a genuinely useful feature that covers a real cost. For you, the investor, a company offering this shows they're actually thinking about comprehensive coverage. Now, let's look at something a bit more tricky: critical illness policies. These plans play right into our biggest fears about getting a major disease like cancer. But here is the massive catch. The term critical illness has no standard definition. The policy will only cover a very specific, limited list of diseases, and even then there's often a clause about specified severity. This means you could literally be diagnosed with cancer, but if it doesn't meet the policy's exact technical definition of severe, you get absolutely nothing. It can be super misleading, so yeah, we're calling this one slightly gimmicky. From an investor's perspective, if a company's strategy leans heavily on selling these, it could be a red flag. I just mentioned a super top-up, so let's unpack that. This is a really crucial area to understand, because the difference between a plain old top-up and a super top-up plan is way more than just a name. It's a total game changer for the customer, and it's a huge tell for you as an investor. But first, a really quick definition, because this is the key to the whole thing: the deductible. Think of it as the initial amount you have to pay, either from your wallet or from your main insurance policy, before the top-up plan even starts to contribute. It's like the cover charge you have to pay to get into the club. Just keep that idea in your head. So let's see how a standard top-up plan works in the real world. Imagine your first hospital bill of the year is for 7 locks. Your base policy covers the first 5 locks. That's your deductible. Then the top-up plan kicks in and pays the remaining 2 locks. Great, right? Well, here's the kicker. Let's say you have another hospital visit later that year and the bill is 3 locks. With a standard top-up plan, that 5-lock deductible resets for every single claim. Since this bill is less than the deductible, the plan pays nothing. 0. You are on the hook for the entire 3 locks yourself. It's a classic example of a product that looks good but doesn't deliver. Now, watch what happens in that exact same scenario with the super top-up. The first bill for 7 lakhs, it works the same. Your base policy pays the 5 lakh deductible. The super top-up pays the rest. But now, when that second 3 lakh bill comes along, the plan recognizes that you've already met your deductible for the year. It doesn't reset. So what happens? The super top-up just pays the entire 3 lakh bill. The difference is night and day. It's infinitely more useful for the customer. So what's the big insight here for an investor? That one tiny little detail, whether a deductible is per claim or annual, it tells you everything you need to know about an insurer's philosophy. Are they focused on creating quality products that people can actually rely on? Or are they selling policies with hidden trapdoors? Companies that offer and promote super top-ups are the ones building a business on trust. Okay, so we've looked at the products. Now let's shift gears and talk numbers. As an investor, you have to know how to measure an insurance company's performance. So what are the key metrics you need to look at to figure out if a company is financially sound and treating its customers fairly? You see this number everywhere, a 99% claims settlement ratio. Wow, right? It looks fantastic. It makes you think this company pays out on pretty much every single claim that comes through the door. But can a number like that be misleading? Oh, you bet it can. And it's actually not that hard to do. Let me show you how.
See, the problem with the claims settlement ratio, or CSR, is that it only measures the number of claims settled, not their value. This makes it really easy to game the system. An insurer can just quickly pay out thousands of tiny, small-value claims. At the same time, they could deny a few really big, expensive claims. The result? Their CSR looks amazing, but they're failing customers when they need help the most. It is the perfect example of a vanity metric.
So if the CSR is so unreliable, what's a better metric? Well, you want to look at the incurred claims ratio, or ICR. This one is all about the value of the claims. The calculation is simple. It's the total value of all the claims they paid out divided by the total amount of premiums they collected. It gives you a much, much clearer picture of what's actually going on financially. Let's just put it side by side. CSR measures the volume, how many. ICR measures the value, how much. CSR can be gamed pretty easily. ICR is a true indicator of financial health. CSR tells you if they settle claims, but ICR tells you if their entire business model is actually sustainable. For an investor, it's no contest which one matters more. And understanding ICR is pretty straightforward. Think of it like a Goldilocks range. If it's too low, say under 60%, it could mean the insurer is just being stingy and rejecting way too many claims. If it's too high, over 100%, they're paying out more in claims than they're taking in from premiums. That is not a recipe for long-term success. The sweet spot? The healthy range is usually somewhere between 60 and 90%. That tells you the business is both paying its claims and running a sustainable operation. That's the number to watch. All right, we've covered products and metrics. Now let's look at another really key part of the health insurance world, customer power. And one of the most important tools a customer has is something called porting. It's a fantastic indicator of a healthy, competitive market. So what exactly is porting? It's simply the ability to switch your health insurance policy to a new company without losing all the benefits you've already earned. The big one here is waiting periods. If you've been with one company for 3 years and you've already waited out the period for a pre-existing condition, porting lets you take that credit with you to a new insurer. This is a game changer. It means insurance companies can't just take their customers for granted. They actually have to compete on service and price to keep you. Now, of course, there are a few rules. You have to apply within a certain window before your policy renews, and the benefits you carry over are usually for your existing coverage amount. But the main point for us as investors is that the existence of porting is a great sign. It points to a dynamic, competitive market, and a competitive market is a healthy market. So, we've looked at products, we've decoded the metrics, and we've talked about customer rates. What does this all add up to for an investor? Let's put everything we've learned together into a simple, powerful framework. Here it is, a simple checklist for evaluating any company in the health insurance sector. 1. Look at product quality. Favor the companies that sell transparent, customer-friendly products like Super Top-Ups. 2. Check their financial health. And remember, your go-to metric is the ICR, not the CSR. You're looking for that healthy 60 to 90% range. 3. Look for signs of customer focus. A market where customers can easily port their policies as a good sign. And finally, number 4. Always take the long-term view. Companies built on gimmicks might get a short-term sales bump, but the ones built on trust are the ones that are going to win in the long run. And that really brings us to the final, most important point. When you strip everything else away, the health insurance business is about trust. It's a simple promise. We will be there for you when you need us most. In an industry that is literally built on risk and promises, the biggest gamble any company can possibly take is losing the trust of its customers. And as an investor, that's one risk you just can't afford to ignore.